Hi, I'm Adam Thurgood, Managing Partner of Hightower Las Vegas, and I'd like to spend a few minutes with you discussing our investment philosophy. Our investment philosophy is built with the foundational belief that value matters over the long run. Warren Buffett once said that price is what you pay, but value is what you get. This simple yet powerful concept is at the core of everything we do. Now, built on top of that foundation of value are four key pillars that drive our investment process. We take an integrated approach with a macro mindset, focused on risk management and true diversification. So let's dive into each of those in a bit more detail. As wealth managers, our main objective is to help our clients achieve financial success. However, everyone has a different definition of success. By integrating the financial planning process with in-house investment management, we believe we're better able to align portfolios with financial planning objectives. Put simply, we believe the purpose of the investment management process is to help clients achieve their goals. And having that clarity is critical, because in the words of Yogi Berra, if you don't know where you're going, you'll end up someplace else. Now, we live in a complicated world where big picture forces like central bank activity or liquidity flows or geopolitics play an outsized role on asset prices, valuations, and risk environments. And by starting at the big picture macro level and developing a global view, you can uncover pockets of value and identify areas of increased risk. We also believe that by focusing on the market and listening to it, by studying trends and identifying market regimes, we can better triangulate those opportunities and risks. Now, Ray Dalio once said that if you're not aggressive, you're not going to make any money. And if you're not defensive, you are not going to keep it. Having that macro mindset can help identify when you should lean in one direction or the other. Which brings us to our next pillar, which is risk management. Now, there's a general belief amongst investors that higher risk leads to higher return. You see it in graphs like this all the time. However, if higher risk investments always led to higher return, by definition, they wouldn't be risky. Legendary investor Howard Marks brilliantly depicted this by placing probability distributions on top of the typical risk-return graph. And what you can see is, yes, on average, higher risk investments produce higher returns, but there's much greater variability in the potential outcomes, including a much greater chance of substantial loss. And that matters because mathematically, losses matter more than gains. Take this simple example where you lose 50% and then you gain 50%, or vice versa. You end up down 25% despite having an average return of 0. In the words of Diego Perea, there is no compounding without capital preservation. And while we don't believe that you should ever sell everything and go to cash, you have to stick to a long-term approach. We do believe there are times to cut risk and protect capital. Now, true diversification is another way to help manage risk, which requires more than just stocks and bonds. Adding an asset such as gold can help protect the portfolio against a wider set of risks. Now, having said that, it can be really difficult to stick with a truly diversified approach, especially when one asset class is dominating everything else. During the 2010 decade, US stocks crushed everything. They were up 256%. While bonds and international stocks and gold lagged far behind, which could have led someone to believe, well, those other asset classes are not necessary. Let me counteract that with 2 points. Number one, that blue line is far from straight. There were some big drawdowns along the way that would have shaken out a lot of investors. Having a blend of assets that are subject to different types of risk help produce a more consistent experience and keep you in the game. And just because something performed well in one period doesn't mean that that's always going to be the case. All we have to do is go back to the prior decade and see how different outcomes can be. From 2000 to 2010, US stocks lost 9%, while gold returned over 280%. International stocks also outperformed the US by a hefty margin, as did commodities. So if you were just invested in US stocks over this period, it would have been very, very painful. Now, one of the great investors, Sir John Templeton, said that diversification is a safety factor that is essential because we should be humble enough to admit that we can be wrong. Now, we know that we're never going to get every market call right, but if we focus on long-term value and we manage risk along the way, partly by staying truly diversified. We believe we tilt those odds in our favor. So let me leave you with these final thoughts. Every one of our clients has a different definition of financial success. Our job as wealth managers is to help clients define it and also to develop strategies to progress towards it. And while the road to financial success is never a straight line nor free from peril, we believe that our investment philosophy and our approach helps them deal with the twists and turns along the way and reduces their risk on their journey. Thank you.